Hello, everyone. Now we're moving on to economics in the section of growth and investment decisions. Now, the key here is don't get caught up too much in kind of the fine details. What you want to make sure on a lot of these, especially these growth theories, is getting the real big picture associated with it. Look, this exam's not really going to just be too many just plug and chug questions inside the equation. You really just want to understand overall what's happening in a lot of these. All right, so let's just kind of jump into this stuff. Here we go. So, conditions for sustainable growth. So what we have here is, first off, looking at savings and investments within a company. These are highly correlated with the overall growth of a country that has sufficient amounts of savings to make investments into companies to create growth. So next being financial markets and intermediaries. What we've seen is that having a system of exchanges and intermediaries that can facilitate the capital raising process is essential in many cases for growth. Next being political stability and rule of law and property rights. These countries or developing countries that don't have a stable political system or a stable rule of law or property rights associated may have trouble. Companies in those countries may have trouble actually raising capital or attracting capital to those because of the lack of those types of things. Now, next being investment in human capital. What are we talking about here? Things such as education, training, getting the labor force skilled enough to provide for situations for growth. So what we've seen is that, for instance, for developing countries, investments in higher secondary education benefit most from in those areas. And then in developing countries, we're talking about secondary education, and that's where the benefit mostly is seen there. Now, other things, you have taxes and regulatory system with, typically with all else being equal, for facilitating growth, lower taxes and lower regulatory burden systems basically provide for more of a better environment for growth for companies. Other things, we also have free trade and unrestricted capital flow. So in cases of free trade, so as you open up trade barriers, it creates domestic competition. So the domestic firms have more competition. They become more efficient because they have to compete with companies within other countries. And then you also have, with unrestricted capital flows, the domestic firms now have access to, let's say, foreign capital. So all of these things provide for conditions for sustainable growth within a particular country. So when we're looking at economic growth and investment decisions, what we're trying to do is look at the overall macro level output and how does that actually affect the stock market appreciation? How does it affect the actual investments or the price of the stock? So you'll notice the equation here that the percentage change in price equals the change in GDP plus the percentage change in earnings to GDP plus the percentage change in PE ratio. Now, if you look at the formula above, if I were to multiply this across, you'll notice GDP cancels, earnings cancel, and what am I left with? I'm left with price. This is how this formula works. Now, in the long run, you'll notice that the percentage change in earnings to GDP and the percentage change in PE ratio actually will equal 0. The reason why is that the percentage change in earnings to GDP, labor is not going to accept a smaller share of GDP. This is why this becomes 0. The second piece is that notice that the percentage change in PE is also 0 because investors will not pay a never-ending increase in price for the same level of earnings. This is why PE ratios cannot grow forever. And so the growth in equity prices equals the GDP growth rate. So looking at the potential GDP, so higher the potential GDP growth rate, higher the real rates, meaning interest and asset returns. Now, what are some of the implications for fixed income investors? Well, when the actual GDP growth becomes greater than the potential GDP growth rate of the country, then we start to see inflationary pressures, prices start to rise. Now, remember what we saw in the previous class with the Taylor rule where if the actual inflation is greater than the target inflation, we start to see these inflationary pressures. Then there's this fear that we might start to see monetary and fiscal restrictive policies. Now, what happens then? You start to have, They may raise the discount rate, reserve ratio, or start selling bonds, which cause interest rates to rise and bond values to fall for fixed income investors. Now, higher the potential GDP growth rate does reduce the overall credit risk of all debt issues, meaning credit spreads start to tighten as the economy starts to grow, have a higher potential GDP growth. Now, let's talk about capital deepening and technological process. Now, before we jump into this, let's just kind of do a refresher, and that way we can kind of think about, because I know there's some formulas that are going to represent some things, but let's kind of make it a little bit at least real and a little bit fun, so that way we can think about things in a way. So let's see, we'll do an example here. So let's say we own an island, let's say off the coast of Hawaii, all right? The reason why is probably, and I'm saying Hawaii, is because it's probably cold outside. You're all thinking about you want to be in someplace, you know, nice tropical. Just visualize with me, a nice tropical beach. It's an island, okay? So you're on this island with me, okay? And now, couple of rules on the island. So all of us on the island. Couple rules on the island, all right? So here are the rules on the island. No one on or off the island, and no funny business, meaning there is no increase or decrease of population on our island at all. So it is just us, okay? So we're on our island. Now you can visualize it. It's got palm trees, all right? There's coconuts. Let's say we start to make, hula outfits that, you know, with coconut bras and the hula dress and everything, and that's what we specialize in. This is going to be our output, okay? So we start making these, and we start exporting, we start selling them to, you know, let's say we start selling them, out there online, or let's say on Amazon, and then we start making them, they start to become popular, people start to buy them, right? And let's say Kim Kardashian buys one, and then everybody just wants them. So everybody is now saying, hey, I want these hula outfits from, you know, Jeff and all their CFA candidates on this island. So they all start buying it. We all start working, right? We all start working, and we're working 8 hours a day because, even TMZ started doing a piece on it. So we just basically just keep making these. We're working 8 hours, we're working 12 hours, we're working 15 hours, we're working 24 hours a day. Now, at this point, can we work a 25th hour? So our output is just maxed out, right? We are at basically the long-run output. We can't work any more past that. Now, let's say somebody comes in and says, hey, I really want one more outfit. Can we build that, or can we make that particular outfit for them? We can't. So the only way we are able to fill that order, there's essentially two things that can make this happen. First off, we break the rule. We get more people on the island to help us make it, right? And this means what? We add labor. We add additional population, whether through letting people on the island, or AKA what we call immigration, or let's say funny business. It doesn't matter. Just it's increase in labor. All right. The other way we could do it, let's say we don't want to break that rule. The other way we could do it is we get a machine to build it, right? We create technology to build it for us. This then will increase our output now, right? Now we can make more of these outfits. Now, keep in mind, just because we have the machine or the blueprints for the machine, just because we have more people on the island, those people could potentially just be, sitting on the beach drinking pina coladas, doesn't mean they're actually going to be productive. What we actually need to do is have capital to invest in these particular items, to invest in the technology to actually build the machine, or invest in the labor to basically train them and allow them to also learn how to make these outfits. So with that thought process, now let's go back to the slide here, and let's take a look at what we see as the Cobb-Douglas function. All right, and a lot of these things should look familiar. You'll notice that you have output, and what basically shows output? Basically our technology, right? Our increase in technology, our increase in labor, and what kind of what waters this process or provides for these two items, the machines and the additional labor, is the capital. So as we inject capital, then we potentially can build the machine, we can train the labor force. And what you see here, the alpha is the share of output allocated to capital, and 1 minus alpha is the share of output allocated to labor. And T is the total factor productivity. Another kind of just think about that as the overall technological growth. So in the Cobb-Douglas function, there's a diminishing marginal productivity of labor and capital, but a constant returns to scale. So think about this, all right? So if the output to labor, keep in mind, this is less than 1, meaning they both have to add up to 1. And so this exponent is less than 1. So this creates, now keep in mind, like for a positive, an exponent greater than 1, what do we have? We have an exponential growth, like that. Now, if the exponent is a decimal, what do we have? It goes the opposite direction. We have a diminishing productivity, right? So keep in mind, this is the implication of that 1 minus alpha in that exponent. So as we add capital, sure, this the output is increasing, but it will be increasing at this diminishing rate. So in the steady state, the marginal product of capital. Now, don't misunderstand the difference between the marginal product of capital and the marginal productivity of capital. The marginal product of capital is basically what we're talking about is the additional, as I inject capital, how much output am I going to get? The marginal productivity of capital is as I give the system more capital, how much more output per capita or per labor is actually out there, meaning how, as I put more capital in, how much output per worker is it actually showing me. Now, in the steady state, this marginal product of capital, output per unit of capital, equals the rental price of capital, right? Notice this is the share of output allocated to capital. Here is my output, here is my capital, and this equals the rental price of capital. All right? Now let's take a look at the productivity curve and economic growth. So you probably saw in your reading here the actual equation. So we have output per labor, or what they call GDP per worker, right, equals the capital per worker. So let's just say capital per labor. This is essentially our x-axis. And our slope's going to be technology and growing at a diminishing rate of alpha, which is the output allocated to capital, right? So let's take a look at how this works here. So as I run this equation through, I have a specific value of capital per worker. It will create a labor productivity or GDP per worker. So this is where I'm starting. I put in the value of capital per worker, and this is my kind of labor productivity. Now, as I move this way, and I basically add more capital per worker, I inject capital into the system, what happens here? This effect is called capital deepening, meaning I'm actually adding more capital per worker. You'll notice here I have an additional labor productivity, but it is increasing at a diminishing rate because why? Because the exponent of the equation is less than 1. Now, keep in mind that, remember, 1 minus alpha is the amount that is what? Allocated to labor. If this is larger, then this is smaller. And when that portion, when alpha is thereby smaller, the diminishing rate is going to be greater. Now, let's take a look at what happens if what effects of the slope. As I have more technology, so the technology, with more technology, what happens to the slope? The slope actually increases. So there is my more technology. And notice with the same amount of capital deepening, I actually get more labor productivity, right? And it should make sense just from a theory standpoint. A more technological dependent country, as you add more capital to it, you're going to have more labor productivity per worker, or there's a higher standard of living. As opposed to labor-intensive manufacturing countries, as you add more capital, sure, there's going to be an increase in productivity, but it's going to be at a higher diminishing rate. And with less technology, there's going to be essentially less labor productivity or output per worker. So the productivity curve is the graph of labor productivity versus capital per worker for any given level of technology, given technology is the slope. Now, you can notice there's two sources of economic growth, meaning growth in labor productivity or output per worker. So the growth, first off, is the growth in capital per worker, right? K, capital per labor. This is essentially this capital deepening effect, right? This is my x-axis, or I actually change the slope, right? So just kind of thinking about it in theory, what does that mean? That means my y-axis, that my labor productivity is going to go up in two ways. One is that I change the slope and I have a steeper increase due to technology, or I move along the line, and as I move along the line, I'm creating capital deepening. I'm injecting more capital per worker. All right, looking at the growth accounting relations, so we saw the Cobb-Douglas function that gave us basically the potential GDP or the output. Now, the growth accounting equation, if we're looking at the growth, now we take the percentage change, so the growth rate of total factor productivity, or what we call technology. Then we have the long-term growth rate of capital multiplied by its elasticity, or output allocated to capital, and our long-term growth rate of labor times its elasticity as well. The growth accounting relations continue. The labor productivity growth accounting equation, the growth rate of potential GDP, is the long-term growth rate of the labor force plus the long-term growth rate of labor productivity. Now, keep in mind, labor productivity includes what? Capital deepening and changes in total factor productivity. So just kind of a simple way to think about it, meaning that the change, growth rate in potential GDP, right, equals the potential change in labor plus what? Kind of, from the previous equation, it was basically everything else in the equation on the previous slide. Meaning what? Meaning capital, the increase in capital, and changes in total factor productivity, meaning changes in technology. Now, notice I can actually take this equation and basically do what? I could put it and equal the equation that we saw in the previous slide. So if I am given long-run growth rate of labor, what they call labor productivity, if you give me labor productivity, this is kind of the everything else thing. It includes the capital deepening, changes in total factor productivity, right? So let's take a look, kind of a quick example of how this kind of can show up in a problem here. The following information for Bondovia, and what we have here is the labor force growth rate of 1.2%. So what does this look like? This is change in labor over labor. The cost of labor to the total factor cost, this is what? The amount that's allocated to labor. Now, if 54% is the amount of output allocated to labor, then what is actually allocated to capital? So 54, that means the other side has to be what? Alpha has to be equals what? 46%. This is the amount allocated to what? Capital, right? Now, the growth rate of capital is the change in capital, right? And then the growth of labor productivity. Now, keep in mind, this is what? This is kind of what I called in that last slide, how I think about it is like everything else, which includes what? Capital deepening and total factor productivity. Right? Capital deepening and total factor productivity. So just as a review of what we just saw in the last slide, your output equals the change in labor over labor plus kind of this labor productivity number or everything else. Now, what are we looking for here? The growth rate of potential GDP and then the impact on total factor productivity on growth, meaning technology. All right? So let's take a look here. Because we are not given the growth rate in technology, we have to use the second relationship that we just saw. So the growth rate in potential GDP equals the long-run growth rate of the labor force plus the long-term growth rate in labor productivity. So let's take a look. So how do we do this? Keep in mind, what is this? What we have here is the long-run growth rate of the labor force, right? We were given that. And then this is the labor, productivity, everything else. This gets me to 3.2. Now, I take that and I put the 3.2. So 3.2 is now my output, my growth rate in potential GDP, right? And remember the equation before, what we had here, this was what? This was amount, the elasticity, or the amount allocated to capital. This is the change in long-run growth rate of capital. And then this is what? Amount allocated to labor. And this is the long-run growth rate of labor. Right? So, they've given me everything else. What are they looking for? How much is the total factor of productivity? And if we do some algebra and solve for that, you'll notice what I get to. This is 0.92%. This one is 0.648%. And what do I get to here? That means my total factor productivity is 1.632%. Notice how I set the two equations to each other and was able to solve for the one that was missing. So taking a look at what is the impact on natural resources. So ownership of natural resources is not as important. So as long as you can have access to them via trade, meaning a great example would be Japan. They don't have huge amounts of natural resources, but they can import them. So not such a big issue as long as they have access. Now, in some cases, ownership of natural resources may actually hinder growth, like what they call the Dutch disease, that ownership of natural resources basically pushes up the value of the domestic currency, which makes everything else more expensive for other countries to buy, and it's at the detriment of other industries. And basically, these other industries start to get neglected. For instance, if I'm exporting a ton of, let's say, oil and natural gas, it drives up my currency. Everything else that I'm trying to export then becomes more expensive because of all of the natural gas and oil that I'm actually exporting. We saw this, I think, in Russia in the early 2000s, and countries that have huge amounts of exports in oil, like Kuwait. I think they've even set up a future growth fund to kind of address some of these issues. All right, looking at the labor supply. What are some of the factors that affect this? So we have demographics, the aging population. So as the population starts to age past the working age, or if you have a younger population, it has a higher potential for growth. The participation, which is the labor force divided by the working age of the population. Keep in mind the labor force being parts of the population that are actually working or actively seeking work. Immigration can be a great way, basically, if you have that aging population or declining labor force, to overcome that declining labor force. In our example, just with that Hawaiian island, just getting people on our island to help us make stuff. And also the average hours worked. This can be based off of cultural factors or regulations to say certain number of hours, only there's a maximum number of hours to be worked, or overtime, or taxation, given that in many countries income is actually taxed at a higher rate. This kind of promotes people to take more leisure time and kind of promotes more part-time workers. So capital and technology. So there's human capital, which is the qualitative measure of knowledge and skills through training, education. And then you have physical capital, which is physical capital that is ICT, or what they call infrastructure, computers, and telecommunication capital, or telecom, right? So infrastructure, computer, and telecom. So physical capital can come in the form of ICT or non-ICT, right? Typically in ICT, non-ICT is basically what? Things such as machinery and transportation would be examples of non-ICT physical capital. So there's also in technological development, it basically includes investment in physical capital and human capital, right? Making sure that you have the engineers as well as the infrastructure in place for them. So there's also public infrastructure. What are we talking about there? Roads and bridges. And keep in mind, these like roads and bridges, they both benefit, they also benefit private investment. As you have, goods can travel more freely, things are shipped. As you have these public infrastructures are also important. Now we're going to kind of get into different types of growth theories. All right, so key here is we have classical growth theory, neoclassical growth theory, and then endogenous growth theory. All right? Make sure you just be able to distinguish from the major tenets. And look, don't get caught in the detail. Focus on the big picture here. All right? Let's take a look here. So looking at the classical growth theory, the main point here is that there's no permanent improvements in standard of living from new technologies. And how do I look at standard of living? You know, GDP per capita, or let's say output per labor. So let's say, for instance, in theoretically speaking, let's say China is growing at 7%. But what happens if my population grows at 7%? Then my output per labor is not growing at all, right? So I have two choices. One, I need my output to grow more, or I need my labor to grow slower, right? So if my GDP is growing at a pace, I need to slow down the labor growth rate. And how do we do that? We may institute, let's say, a one-child policy to bring the denominator lower while the numerator output starts to grow, continue to grow at a particular rate. So other things in the classical growth theory, technological advances lead to what? Short-term economic growth. And there are temporary improvements of standard of living, meaning your output's going to increase. There's going to be short-term economic growth, but this is only temporary. Why? Because there is a reversing mechanism, this population growth, right? So what ends up happening is your numerator starts to grow in the short term. Now, suddenly, your economic growth, everybody sees the economic growth in your country, and you start to have what? Immigration come in, the population starts to grow, and the denominator starts to rise. And guess what? That fraction, then, you have both the bottom and top essentially growing at the same rate. And then we have what? Then there's no permanent improvement of standards of living, because as more people come to the country, it basically brings it back down. This is the reversing net mechanism, is that population growth. Okay, so now let's look at the classical growth rate from a curve perspective. So if we start with our capital per worker, and this is our subsistence wage level, you'll see here. Now, as I basically introduce more technology, I'm going to have more, basically, labor productivity, or output per worker, right? So with more technology. Now, under classical growth theory, this is only temporary, because what's going to happen is with this growth in labor productivity or standard of living, more people are going to come onto our island, more people are going to immigrate in. Now, when more people come in, there are more workers. As we have more workers, the capital per worker, because the denominator is increasing, starts to fall. Now, when that falls, here it comes, notice it goes back down to the subsistence wage level. Because why? Because the capital per worker declined because more workers showed up. Now, empirical evidence hasn't supported classical growth theory, but make sure that you understand kind of the major tenets that there are no permanent improvements of standard of living because of this equalizing mechanism of population growth. All right, now looking at neoclassical growth theory here. And the main point here is the economic growth results from essentially lucky discoveries of new technology. Now, the major difference with classical theory is economic growth is independent of population growth. And you have to understand that the neoclassical growth theory really focuses on estimating the long-term steady-state growth rate, or what we call equilibrium. And the economy is in equilibrium when the output to capital is constant. And when the output to capital is constant, the labor to capitalization and output per capital grow at a equilibrium growth rate. So in technological advances essentially will then lead to short-term economic growth, however, permanently higher living standards or higher standard of living. So now looking at the productivity curve under neoclassical growth theory, you'll notice the marginal product of capital equals the rental price of capital. And as I increase technology, I'm going to see what? The labor productivity increase, or GDP per worker or per capita. So the standard of living is going to increase as I add more technology. So when at this stage, the marginal product of capital now is greater than the rental price of capital. And as I increase the capital, or capital deepening occurs, you'll notice there's going to be a movement along the line, and we're going to have an additional increase to labor productivity. And once again, the marginal product of capital will equal the rental price of capital. Now, under neoclassical growth theory, we'll notice that the sustainable growth rate of output per capita, or per person, is the growth rate of technology divided by the output allocated to labor, which is the 1 minus alpha, right? The amount of the output attributable to labor. And then the sustainable growth rate of output is essentially the growth rate in technology divided by the amount allocated to output allocated to labor plus the change in labor. Notice that the sustainable growth is not affected by capital. There is no K in the equation. So in the steady state growth rate, the productivity depends only on technology and how much is actually productivity output allocated to labor. Now, the major tenets for neoclassical growth theory: capital deepening only occurs affecting output, but not the growth rate, right? Economies will move towards its steady state equilibrium regardless of initial capital to labor ratio or level of technology. And the steady state savings and investments are just sufficient to cover new workers and any capital depreciation. So notice how that's very different than what we would see in classical growth theory, where population essentially is an equalizing mechanism. Now, major tenets continue. Developing countries with low capital to labor would have lower diminishing marginal productivity of capital. Under endogenous growth theory, the main point is the economy is a perpetual machine, right? Because there's essentially a no-stopping mechanism to it. And the main kind of point here is technological processes, what they call endogenous, or originating from within. So let's take a look at what this means. So they're saying it's a never-ending process, that as there's more capital per labor hour, as we add more technology, labor productivity just increases and increases. And how does this thought process work? So endogenous starts with innovation, right? And that innovation then leads to higher profits. Higher profits leads to more investors investing, and then more investment leads to more social returns, which thereby leads to more innovation and then higher profits. So it's kind of this never-ending cycle. The part that's different is the neoclassical view lacks this particular step, that the social return to innovation. So looking at convergence hypothesis, so absolute convergence basically says that the standard of living will converge globally as productivity differences between developed and developing countries diminish, meaning developing countries eventually will achieve the standard of living of the developed countries. So that's absolute convergence. Now there's also conditional convergence, which converges only for countries with similar savings rates, population rates, and production functions. Then there's also club convergence. Basically, countries belonging to a club will converge. Countries are clubs are countries with similar institutional features, meaning savings, financial markets, education, health, property rights. This kind of explains why countries with that haven't instituted political or economic reforms tend to lag. So some of the incentives to essentially private investing. So first one, this social returns. There's external benefits to the economy for investing in research and development. Now, private benefits may be insufficient to cover the required rate of return of some of these research and development projects. So this is why when private benefits and social returns are together exceed the required rate of return, government subsidies may provide incentives to invest in R&D, meaning in some cases, in private investing, the private benefits, meaning the return I'm going to get to actually pursue this particular R&D project, may not be enough for me to make this investment. Now, keep in mind, there are these external benefits to pursuing this project, And what we can do is the government can actually come in, provide subsidies and incentives to basically put that, to sufficiently cover and entice the private investment to come in to push the R&D projects through, because there are these social returns and external benefits to those R&D projects. What happens when we have removal of trade barriers? With the removal of trade barriers, there are benefits of growth via access to foreign savings. So foreign savings, foreigners can invest within the country. There's a comparative advantage to production. And there's also economies of scale. Under neoclassical growth theory, you'll notice, remember, neoclassical is focusing on that long-term focus, and that they focus on convergence, that you have not reached the diminishing returns of capital, and that endogenous growth theory focuses on what? Social benefits, that innovation piece, that firms survive essentially with increased foreign competition, and these benefits are beyond those by just the firm. So if you remove these trade barriers through this competition, there's going to be this innovation competition, and everybody benefits. There's these external benefits as well. So keys to the exam here. We first looked at sources and preconditions of economic growth. We looked at labor productivity growth and productivity curves. We saw, you had your capital deepening and your labor productivity. In each of the different growth theories, you have classical, neoclassical, and endogenous growth theory. And then just briefly on the convergence, you had absolute convergence, conditional convergence, and club convergence. So this kind of section, basically, what you're looking at is don't focus too much on each of the details, especially on the theories. Make sure you get the big picture and make sure you get the big points.